Our first example involves the concept of depreciation, or the accounting convention of recognizing a tangible asset such as machinery and equipment, consumption, or use over its useful life. Amortization is the same idea related to intangible assets such as prepaid insurance. A broad definition of an asset is something with a future value. Therefore, when an asset loses value over time, that loss of value must be recognized as an expense, which represents the quantification of the loss. Depreciation and amortization are the nomenclature accountants use to represent an asset's loss of value over time. Because the exact life of an asset, such as machinery and equipment, is not known with absolute certainty, an estimate is made as to an asset's useful life, and therefore periodic depreciation and amortization is based on an asset's original cost divided by a number of periods. Usually monthly increments are used. So in our example, let's say a $60,000 piece of construction equipment was purchased on January 2nd, 2013 with a check, and its estimated life was 5 years or 60 months. Now I want you to pause a second and think about how you would record the first part of the transaction. As I indicated, a $60,000 piece of construction equipment was purchased on January 2nd, 2013 with a check, and its estimated life was 5 years or 60 months. So what would be the first thing you would do? Well, since we wrote a check, the first part of the transaction would be to go to banking, write checks. Let's say we bought the construction equipment from East Bayshore Tool and Supply. As we said in our example, the date was January 2nd, 2013, so this is the date we put in, and let's say the check number was 12345, and as we said already, the amount is $60,000. The memo we could put in XYZ construction equipment, and now the question I want to ask you is this: what tab would you use, and what account would you associate this purchase with? There are actually two potential answers here. First, you could use the Expenses tab, which allows you to select whatever account you want and put in the amount, memo, customer job, whether you want to make it billable, and you can assign a class. The significance of each field is covered in Lesson 8. If you did use this tab, and please remember, even though the tab says Expenses, you can use an account other than an expense account to record your transaction. And in this case, you certainly would want to do that since what you are purchasing is an asset. In fact, if you click on the drop-down menu, you would want to choose a fixed asset, since a fixed asset is a long-term asset, which is an asset with an estimated life over 1 year, which this purchase represents. Given the choices available for fixed assets, the best choice is the construction equipment account to represent this asset purchase. Let's say we leave the other fields blank since we don't need to put in a memo, customer, job, or class. So this is one way of recording this purchase of this fixed asset. The other choice is we could use the Item tab, and we could set up this purchase as a fixed asset item type by typing in the name we want to call this fixed asset, and then since this fixed asset item does not exist, we would be prompted to create a new fixed item by populating the various fields to create a new fixed asset item. If we went back to our debit-credit matrix, we could indicate how this transaction was recorded behind the scenes through the write checks function by debiting the fixed asset construction equipment account for the $60,000 purchase and crediting the bank asset account for its decrease to buy the construction equipment fixed asset. So at this point, we went to the balance sheet to see our financial position as of January 2nd, 2013. We would see that our cash account has been decreased by $60,000 and that our construction equipment fixed asset account has been increased by $60,000. Now, if I ask you what would happen if we never did anything again, how long would the construction equipment fixed asset account reflect the $60,000 increase? If you answered it would reflect this increase forever if we never did anything again, you would be correct. But what is the truth as to what is happening? The economic reality is the value of the construction equipment fixed asset is losing value every month. In other words, the asset's value is depreciating over time. And to what extent is it depreciating on average? As we said before, the $60,000 construction equipment fixed asset has a useful life of 5 years or 60 months. So it's losing $1,000 a month based on our estimate. So how do we reflect this in QuickBooks? If you answered by using a journal entry, you are correct again. So now let's go through how you would set up this journal entry. Again, to open up a journal entry, go to Company, Make General Journal Entries. Let's date our journal entry for January 31st, 2013, since this represents the end of our first month of using the new asset we purchased and therefore the first month of depreciation. Since we said our depreciation is going to be $1,000 a month and we know that debits have to equal credits, we could start out with this journal entry by putting in $1,000 in both the debit and credit fields. Now the question is, what account do we debit and what account do we credit? Since we know one of the accounts is depreciation expense, which is a type of expense, would this be a debit or a credit? Let's go back to our debit-credit matrix to figure it out. If we look at our matrix and look for the expense type of account, we can see when we increase an expense, it would be a debit. So let's go back to our journal entry and put the depreciation expense account where we've debited $1,000. Now, what account would be credited? Since our asset, the construction equipment, is losing value each month, and we are recognizing the loss or expense through depreciation, the offsetting credit entry must reduce the value of the fixed asset. To recognize the decreased value of the fixed asset, we use an account called accumulated depreciation, which is still a fixed asset type of account, but it carries a negative balance, which is a credit balance for an asset. Let's again go to our debit-credit matrix to bear this out. Remember, the first part of the entry was to increase an expense, so we'll put in $1,000 here, and now the asset account is decreased through the accumulated depreciation account by $1,000, which is a credit we'll put here. Notice we are in balance, and our entry will make our accounting records correct. We can now put in a memo in class. We won't assign this entry to a customer job in our example, and then we can save this entry by clicking on the Save and Close or the Save and New. But before we do this, let's think about a way of saving us a lot of work down the road. Remember that we said the construction equipment we purchased has a life of 5 years or 60 months, and we just now only recorded the first month depreciation expense and reduction of the fixed asset's value. Well, this would mean I have to make this entry 59 more times in the future, which is a lot of individual entries I would have to make unless we do what? Hopefully you recognize we can memorize this entry so we don't have to do this entry manually again and again. We discussed how to memorize a transaction in Lesson 4, but just as a refresher, you can memorize this journal entry by going to the taskbar on top, and you can click on the Memorize icon and complete the Memorize transaction window. You would put in a name like monthly depreciation. Then I like to select automatic transaction entry, so I will be reminded to accept the entry each period when it is due. And then I would select from the How Often drop-down menu how often I want this entry to occur, which would be monthly in our case. Then you can put in the next date, which would be February 28th, 2013. Since our first entry that we still need to save is January 31st, 2013. Then finally you can put in how many are remaining, which would be 59 in our case, and if I wanted to be reminded so many days before it is due, I can put in whatever number of days I want in the days in advance to enter field. Once I click on OK, the memorized entry will be saved, and then I need to save my original entry. Now I'm done with all the setup I need to do for my journal entry to reflect the depreciation of the fixed asset I purchased. Also, I wanted to share with you, just so that you understand how this entry affects the related financial statements and expense side of the journal entry, which is here. And if we drill down on the amount for the month, we will see the debit side of the entry. And then let's go to the balance sheet and see that the accumulated depreciation account, which carries a credit or reductive asset balance, was increased by $1,000 as evidenced. If we drill down on the $1,000 credit entry we made in our journal entry. We will do another example in the next exercise to look at how you would handle, with journal entries, allocating the purchase of an intangible asset that relates to more than one period of time.